Imagine a world where the very tools that build nations are now shackled by the policies meant to protect them. That's the reality for the industrial machinery sector today, where Trump-era tariffs and shrinking demand have created a high-stakes chess game for giants like Caterpillar, Cat, and Deere Co. DE. But here's where it gets controversial. Are these tariffs truly shielding American jobs, or are they quietly eroding the competitiveness of the very companies they aim to bolster? Let's break it down. Tariffs, the invisible tax on innovation and growth. The Trump administration's aggressive tariffs on steel, aluminum, and other imported components have hit capital-heavy industries like industrial machinery harder than most. Caterpillar and Deere, both reliant on global supply chains for everything from raw materials to cutting-edge electronics, are now grappling with a brutal cost crisis. In Q2 2023 alone, Caterpillar's operating profit plummeted 18% as tariffs drained $350 million from its bottom line. By year-end, the company projected a staggering $1.3 to $1.5 billion tariff burden, with 55% of that hitting its construction division. Deere, meanwhile, reported a $200 million tariff blow in Q3 2023, with full-year costs expected to top $600 million. These numbers aren't just cold figures, they're a wake-up call. Tariffs aren't just a one-time hit, they're a compounding drag on margins, especially when companies can't simply pass those costs to customers. Demand downturns when buyers hold the cards. Tariffs alone aren't the whole story. Weak demand in agriculture and construction has left Caterpillar and Deere in a tight spot. For Deere, plummeting crop prices for staples like wheat and corn have farmers delaying tractor and combine purchases. This has forced the company to slash prices in its agriculture segment, even as production costs soared. The result? A 47% dive in operating profit for Deere's construction division in Q3 2023, despite only a 5% sales drop. Caterpillar faced a similar crunch in its resources segment, where mining and quarry demand softened, leading to a 25% profit plunge. And this is the part most people miss. In a low-demand environment, pricing power evaporates. Companies can't just raise prices to offset tariffs. They're stuck absorbing the costs, which is a death knell for capital-intensive firms where fixed costs are already sky-high. Survival strategies, short-term fixes versus long-term vision. Both companies are scrambling to adapt. Caterpillar is doubling down on dual sourcing for critical parts and slashing discretionary spending, while Deere is streamlining its workforce and optimizing inventory. But these are stopgap measures. Caterpillar's CEO, Joe Creed, has openly called for greater certainty in the tariff landscape, underscoring how unpredictable trade policies paralyze long-term planning. Deere, on the other hand, is leveraging its inventory management expertise to align production with retail demand, a tactic that helped it outperform Q3 2023 earnings despite the headwinds. Yet neither company has tackled the root problem, their reliance on imported materials. Caterpillar's Energy and Transportation division, which saw a 4% profit boost in Q2 2023, hints at resilience in high-growth areas like data centers. Deere's pivot to agricultural equipment rentals could smooth demand volatility, but it also risks long-term revenue stagnation. Investor dilemma. Can innovation outpace the tariff hurdles? For investors, the burning question is whether Caterpillar and Deere can counteract margin compression through innovation and diversification. Caterpillar's foray into energy and transportation is promising, but still in its infancy. Deere's focus on rentals and cost discipline is a safer bet, but may not drive explosive growth. The sector's exposure to U.S. trade policy is staggering. global firms could face a $13.6 billion to $15.2 billion hit by 2025. This raises a provocative question. Should companies lobby for tariff exemptions, or is it time to re-engineer their supply chains entirely? The road ahead, diversification as the new lifeline. While Caterpillar and Deere have shown operational agility, their long-term survival hinges on navigating this high-tariff, low-demand maze. For now, investors should prioritize companies with diversified revenue streams and pricing flexibility. Those with a contrarian streak might eye undervalued players in the sector, but caution is key until trade policy clarity emerges. In the industrial machinery space, resilience isn't just about surviving tariffs. It's about redefining what the sector can deliver in a fractured global economy. What's your take?